Ladies and gentlemen, we've had a dynamic session today of one of the themes we were just talking about was the potential for cross-market surveillance. And we thought we'd start off, Annika, if you could tell us a little bit about what you're doing within surveillance and maybe some of the case studies we alluded to earlier. Thank you.
Thank you. First of all, thank you very much for having me here. I remember last year's conference, we discussed a little bit cross-market surveillance, but very little. I'm so happy to hear that this is a topic that is so much debated already here. Market surveillance, my job and my team's job is to provide for a high-quality environment for trading and for listing. And you know, we work for the confidence in the market. That's our role. And I'm also very fortunate to be involved with Nasdaq OMX, who sees this as a competitive advantage as well. So it's good for business to have good quality market surveillance. The cases, it's not anything revolutionary, to be honest. We had one case where it was a market maker in a share listed with us who got angry, called us up. He had seen that a member with a direct market access was selling down a share at Nasdaq OMX. The warrant connected to that share was traded on another exchange. That selling down on our exchange, of course, then affected the quotation of the warrant. So he also bought the warrants when the price was going down. And then when the share price got normal, because we had a market maker there, then he turned around the trade and made money. So this was quite a simple case of market manipulation, and we would not have known about it, would not it have been for this market maker who called us, and we investigated and together with the other exchange. But this was ad hoc, and we would never had detected it otherwise. The other case was actually a case that was presented to us by a fellow surveillance team in the US, and there it was two markets involved, a primary market and then another trading venue, and basically this market manipulator, he sold down the share on one of the venues and to then buy a bigger amount for cheaper at the closing auction at the primary exchange. Very simple cases, but cross-market manipulation, basically.
Annika, thank you. Just a follow-up question. In that example with cross-market cash and derivatives, was that an observation that Nasdaq OMX made, or did someone call you to say they were concerned about movements?
It was the client, the market maker, who called us. We would not have seen this. We only see, the problem is that we only see our own market. We only see the trading in our own market. So we would not have detected this without this market maker being, you know, he became angry, pissed off, basically.
Right, no, very good. That's a technical term, ladies and gentlemen. There is one very interesting insight in many of these surveillance examples, and it relates to what Valérie Ledoux from the European Commission mentioned on the last panel, which is any changes implemented by the authorities also have a cost-benefit type of analysis. And this is an excellent time for me to invite up another distinguished authority. This is Nathalie Gallant from Canada, the AMF Quebec. Thank you very much for joining us. So, Nathalie, what's very interesting is in the European examples, no matter how much the exchanges or the existing authorities have invested in surveillance technology, in the specific cases of spoofing and layering, most often it are the examples that Annika mentioned, users calling up saying there's strange behavior in the market, which might suggest the insight that calls for a massive system might only ever be built for the last error that people are trying to fix. But we'll come back to that topic in a minute. First, I'd like to understand a bit more about Canada. Canada is very special. Tell us, just in the equities market, for example, how many exchanges and alternate platforms you have, and how is that operating within the regulatory framework? Thank you.
Well, thank you. Thank you. Donc, for those who wouldn't know how Canada functions on a regulatory basis or the regulatory scheme, is that, first of all, we're composed of 10 provinces and 3 territories, which all have their own Securities Commission. We function under an umbrella organization called the CSA, the Commission Securities Administrators, and what we do is we work together to harmonize regulation. Also, under that umbrella, we've also designated what we call a national self-regulatory organization that we call IROC. And basically, IROC is responsible for the surveillance of all the equities activity. And it's going on 3 recognizes exchanged and 10 ATSs at the moment. The ATSs are also either dark or lit liquidity, but IROC has a centralized responsibility of monitoring these equity markets. We also have the one financial derivatives exchange, which is the Montreal Exchange, which is owned by the TMX Group. And essentially, they are self-regulated, and they do that through their regulatory division. And so they do their own surveillance, and we have IROC, who has the responsibility of looking over all the equities. And IROC has achieved a centralized order book encompassing orders and trades in a chronological order. So for now, that's the structure, anyway, that we have in Canada.
Oh, well, thank you. Nathalie, just to follow up, how does that lead to some form of cross-market surveillance in a country of Canada with 13 different platforms and equities? Thank you.
Well, actually, as securities regulators, and as I said, we all recognize IROC as a self-regulatory organization. So they are frontline for the real-time surveillance, and they will refer in a timely manner to whichever securities regulator it's relevant to. Although, as I mentioned, they're looking at the equities side, the Montreal Exchange are looking at the derivatives, there is a gap in between. The AMF in Quebec being part of this umbrella organization, but also responsible for the supervision of the Montreal Exchange, especially its regulatory division, we have been looking into filling in the gap. And actually anyway, this is a sales pitch, I guess, for tomorrow afternoon, because I'm doing a presentation on this, which is the regulatory gap. But essentially it's what we've recognized, although the 2 SROs do speak to each other, they have all these memorandum of understanding to exchange information. Exchange of information over the phone is one thing, but when you're looking at millions of messages and data, there's nothing, there's a gap. So technologically speaking, IROC has done a major step in centralizing everything that they're responsible for. And so basically, we need to move forward, but I think we've done a major step.
Thank you very much. John White from the SIX Swiss Exchange, come on down. Excellent. And while you're coming, John, it's very interesting to note that last year in Madrid, one of the topics that was raised almost a year after the May 2010 flash crash was also the need for some form of circuit breakers. So I'm going to come to you in a moment, John, but Annika, tell me a little bit about the circuit breakers in place now on the Nasdaq OMX framework.
Yes, we also have circuit breakers, and we feel that there is a need for it. We see that the market is highly sensitive, fast-moving, so therefore there is a need for circuit breakers. So we have, by the share, a circuit breaker that kicks in if the share moves more than 10%, and it's a trading hold for 3 minutes. We can look into the order book, check if there is something wrong, and so forth. And it's a bumper, speed bumper, basically.
And that for not just when the stock falls 10%, it's also if it jumps up as well, is that right?
Also when it jumps up, yes.
Yes, thank you very much. So John, what happened in the Swiss experience?
Well, very similar to what Annika was saying about Nasdaq. So at SIX Group, we take market surveillance and market monitoring extremely seriously, and I think the philosophy can be summarized as one of active market control. What that means is that there's a combination of software tools, picking up on rapid price movements, also supported by a team of at least 4 people, looking into any issues as they arise. So I think that's a really important point that there are experienced people. They've seen these situations in the market before, and they can jump in to establish what's caused a rapid price movement, and that can be one of a number of things. It could be the usual fat finger error made by one of our clients, or one of their clients using a DMA sort of architecture. It could be genuine investment demand. Let's not forget that if news breaks or investors have a genuine need to buy or sell a security, that can trigger that sort of price movement as well. We feel that the Sixth Group also has what we call the avalanche check, steady incremental changes that you might see from a malfunctioning algorithm, for example, if they're repeatedly buying or selling to drive down the price of a stock, which might not trigger the single instantaneous circuit break. So we think that's an important mechanism to have as well as technical controls. So what happens in a situation where an algo does go crazy, eats up a lot of bandwidth, eats up a lot of capacity in terms of the matching engine. So again, that's something that the team can step in and at a technical level adjust bandwidth. But going back to the circuit break is a very, very important mechanism, as Annika said, to have a timeout. The team can decide what to do, the trading bump, if you like. Do we need to call the issuer because there's more information required about the stock? Do we need to call the client? Does he need time to consult with his client? So that's I guess a summary of our approach and philosophy.
Yes. So Nathalie, I'm going to come to you just to explain the North American experience, and particularly Canada. But I think the insight last year was that at the time of the flash crash in the U.S., Europe already had in place a number of these circuit breakers and on a single stock level. Nathalie, what was the experience in Canada, and what have you done? Thank you.
Well, actually, following the flash crash, of course, regulators were all over IROC, especially to try and understand and what was going on. So there was an analysis. Of course, being in Canada, nothing was triggered in a sense where we were at the end result of what was happening in the U.S. Although through the year, there was a lot of analysis proposals, and as of February 2nd of this year, there were some single stock circuit breakers that were adopted in Canada. And on a wider scope, the market-wide circuit breakers are actually being evaluated right now. There's a lot of questions that are arising from that. Same thing as Annika mentioned, the single stocks, where it's a speed bump. And it's specific to our market, and again, the same thing, a variation up or down of 10% within the 5-minute period will trigger this trading halt. On a more broader basis, we've done some consultations with the industry. Of course, IROC is involved. As I mentioned, they're the consolidators, so they need to consolidate, although they can turn the switch to off, but in the market-wide, it would be the responsibility of the exchanges and the ATSs, and of course, this is coordination.
So Nathalie, does that mean that there's a level playing field amongst the exchanges and the MTFs? Do they have to harmonize the framework in Canada?
It's going to be pushed. In the same way that the CSA is harmonizing everything, it needs to be harmonized if it's going to work.
And Annika, what about in the Nordic region with Burgundy, Nasdaq OMX, Oslo Bourse, and others? Is everybody harmonized with respect to the circuit breaker framework?
Well, it's actually in Europe, if you think about our stock, or the companies listed in Stockholm, for example, they are traded all over in Europe. And no, they are not harmonized, and this is a problem, because if the circuit breaker is triggered in Stockholm, it doesn't necessarily trigger at Chi-X. They have different standards and so forth. So this is a problem, and this needs to be harmonized. But what I've understood from MiFID II, this is something that they are looking into, that we will have some kind of a equal standardization in that, because it's unnecessary that it is such a mishmash.
Well, just to be provocative, when we recognize that sometimes where there is a choice of venue to trade and a venue has an outage, it may be possible to continue trading on another venue to get liquidity. Is that a fair comparison with different circuit breaker treatment or not? Thank you.
Yes, we have seen this. We have seen when we have halted trading in one of our shares that it has sometimes, for example, the trading has continued at Chi-X. And I would say this is actually a problem for the clients of Chi-X, because they don't know what has triggered the trading halt. It might be that there is something about the company, because we as a primary market, we have this unique relationship with the issuers and the listed companies. So we are in contact with them, and we know what the trading halt is about. And it usually takes time before the company goes out and informs the market what has happened. It might be in financial difficulty. And then, of course, the other trading venue where the trading is continuing is putting its clients exposed, they are exposed to this risk.
Thank you. John, you had a follow-up comment, sir.
Yes, I'd agree with what Annika's saying. So in speaking to a number of our clients in advance of, of the session here, I think that there's a broad acceptance of that circuit breakers are a good idea, but there is a concern that they are not harmonized across all the venues. So we see that when there's an outage on the primary, there's limited trading seems to happen on some of the other venues. So you could say, well, the problem is sort of it might not be so great. But having said that, many of our clients have invested a lot of time in their smart routers and algos in order to to be able to continue trading when there's an outage on the primary. So I think the time is coming where that's becoming potentially more and more of an issue. It's also an issue if the MTFs introduce standards which aren't aligned with the primary. You could see one venue tripping out, others continue to trade. Then that venue trips out, then the primary restarts, and the net effect is that it's possible to continue trading uninterrupted.
Well, I think we all agree we want a safe market with integrity. So just very quickly, do we have consensus on the panel that there should be harmonization of halts and circuit breakers? Or should we allow the potential for best execution to differentiate and allow liquidity even when another market has a halt from a circuit breaker point of view? What's the quick vote?
The first one, I'm for harmonization.
Harmonized. Natalie?
Should be harmonized, but also look into, I guess, the local market and try and adjust it so it's not detrimental either to the domestic market.
Very interesting. John?
A cautious yes. I foresee potential issues with the implementation in that the rules that apply across individual stocks and different asset classes and the way that stocks trade might be difficult to achieve consensus. But with that caveat, then yes. All
right, so let's just, ladies and gentlemen, just to keep the blood moving, an informal survey. How many are for mandatory harmonization of circuit breakers in Europe? Hands up. How many think competition should decide? Well, a mixed view, but looks like the informal view is overall falling for Annika. Very good, excellent. So now we come on to another related theme, because whether it was erroneous or otherwise, there was association with high-frequency trading with the flash crash. Now, for those of you that actually followed up and read a very good and comprehensive joint report by the CFTC SEC, high-frequency trading was exonerated. But it is interesting to note the concept of robot trading. that we've heard in the Nordic markets. Annika, can you tell us what is robot trading? Thank you.
It is an invention by Swedish journalists, media, about HFT. And there has been a very intense debate in Sweden regarding HFT. And you know, now the exchanges and the trading is just steered by robots, no humans involved anymore. And this is very, very bad. And actually for the small investor, this is really bad. So this has been sort of the discussion. However, it's more balanced now. I would say that our message has gone across that we think that HFT is a trading strategy. There are speculative trading strategies out there. We, as an exchange, provide an infrastructure. If you follow our rules, you're welcome to trade there, whether or not you're speculative or not. The problem we see with HFT or with automated trading overall is the human error, the fat finger. That is the problem I see with so many parties now using algorithms, and they maybe don't test them enough before they use them. Those situations we have had. So we put a lot of pressure on our members regarding pre-trade risk management, and that's the problem, not the HFT as such.
Thank you. Nathalie, I'm going to come to you in a minute, but first I have a question for John, because, ladies and gentlemen, if you've been reading this magazine that's been here at this event, there is the case study of the SIX Swiss exchange adopting the Nasdaq OMX technology in part to attract the higher frequency players in the marketplace, or those that are at least more latency sensitive. So if there is a concern, or should I rephrase, is there a concern that with the new state-of-the-art technology coming from Nasdaq OMX or Millennium IT or others, as an exchange adopting these new platforms, do you feel comfortable you can monitor in these faster and faster times of higher frequency trading?
I believe that we have the infrastructure in place to monitor this type of flow. We already have these type of clients, trading on the exchange, both in a membership capacity and in a DMA, capacity through some of our other clients. You're absolutely right that the trading platform is being upgraded next month, and we think that it will increase the amount of HFT flow on the SIX Swiss exchange. Because I think it's probably fair to say that as an exchange, our percentage of HFT flow is slightly lower than perhaps some of the other markets right now. But back to your introductory comments, I think that's my perception of the flash crash as well, that the HFT participants were savvy enough to know that there was something anomalous in the market. The prices weren't truly representative, and hence quickly withdrew from the market. But it does raise a question about risk controls at all market participants. The non-HFT players, remember, were still looking to execute in a market which was descending extremely quickly, and that raises questions over flow control at that level, but also within the HFT community as well. They're not perfect by any means, and whilst they're less likely to be guilty of fat finger sort of errors, algorithms, as we know, and trading strategies can get out of control. So again, in speaking to one of our clients, there was a case recently where a client hit a warning limit for the number, total number of orders over a trading day within the first 5 minutes of the market operating, and you pick up the phone and say, "Oh, I wasn't aware of that." Fortunately, it didn't have any impact, but that's the sort of thing that can happen. Hence, again, the need to have the active controls in place, the people monitoring the flow, the ability to throttle flow going out to the exchange.
Thank you, John. Ladies and gentlemen, a question for the question for the panel. While you're thinking of a question, very quickly, John, wet finger in the air, what approximate flow in a proportion terms is high frequency on Swiss exchange?
Very difficult to say. And I'm not deliberately hedging the answer to that because, as I mentioned earlier, we see the flow directly from members, which we would classify as HFT. And
is it a majority or minority?
Without doubt, an overwhelming minority.
Annika, Nasdaq OMX?
What would I say? I would say 40% is automated trading, half of it is HFT, but that depends. We can have months when it's more. But the problem I see is not sort of the HFT, it's the algorithms that are used out there, and they are used also by traditional members. So all the banks are using nowadays algorithms. So that's a problem.
Nathalie, what about in Canada?
Well, and I agree with everything that's being said here. As a regulator, of course, I cannot give you those proportions. I'm not that close to the market, but all we know is, and I tend to agree with, in a sense, where what we're focusing on as regulators is somebody has to know where the off switch is in case that something goes haywire, and also to put the responsibility on the risk management and pre-testing and making sure that's being done. And in Canada, we have, as a CSA, actually came up with a harmonized rule across Canada that all brokers that are granting these accesses are responsible to actually make sure that this is going on. So they will ultimately be held responsible if the off switch can be found.
Excellent. Annika, one last question for you from a Nasdaq OMX perspective, a very special organization that's transatlantic. Within your organization, are you looking to harmonize circuit breaker frameworks, Europe and transatlantic in America?
Well, we have circuit breakers in the US as well, but they are not completely harmonized. The US market looks a bit different. I would say it's Canada and the US are a bit different. This single stock circuit breakers that we have in the Nordics, but I know that they are looking into market-wide in the US. So.
Thank you very much. Was there a quick question? There's a question in the middle, unless Mr. McGoldrick wants to have a quick one.
I'll do a very, very quick question. It was for Annika. You say that the main purpose of what you're doing is to maintain and preserve the confidence in the market. And unfortunately, some of the times when you stop a stock, it's just because there is temporarily an imbalance between supply and demand, and that in fact, someone's just traded down through a book and the stock can quite easily bump up. Is it not better when that happens not to suspend the stock, but simply to prohibit trades from happening outside the band, and so that if the forces that have created a potential trade outside the band disappear, the stock can keep trading quite normally and there's no loss of confidence in it?
I think that's maybe easier to say beforehand than before we detect what's the reason behind the price movement. It will take some time. Of course, it would be better. There's also the philosophy that you wouldn't have circuit breakers at all, because it is the market is the market. It should decide whether it goes rises or goes down. That has been also a philosophy that we tried for a few years. We had circuit breakers before, then we didn't have them, then we re-implemented them. And it is to meddle with the market a bit, as you're supposed to. But we think still it's better to have that, and better safe than sorry.
Thank you. Question in the middle. Thank you, Stephen. Thank you.
Thank you. It's an open question to the panel. Does the panel think there is a place, either at maybe an exchange level or even a regulatory level, to register and monitor specific algos? So the logic that's in them, the amount of testing and due diligence that goes into them before they're launched, etc., etc.
Registering algos.
We have been lobbying for that also the HFT firms would be regulated. Then the regulator could look into the strategies behind the algos. So basically they could have the possibility to look into it. That is something that we are for. Whether or not that would be the role of the exchange, I would rather see that it's the regulator that it would be a licensed HFT trader, and the regulator would have that responsibility instead of us.
So Nathalie, are you ready as a regulator to accept all of the risk by giving us a kite mark on our algorithms?
I was going to say, and probably I shouldn't be saying stuff that I'm going to be saying here, but probably that would be a logical aspect and maybe a safe way to do. But to be perfectly humble and honest, I'm not sure the expertise is there. You know, I don't know, an algo wants to register, who's going to look at it, and what's going to be the yes or the yay or the nay. And not to bash on regulators, I shouldn't be doing this, but are algos willing to wait a year and a half before they actually go and trade? So I'm saying it's logical, yes. At one point we need to be informed, and to be quite honest, in certain commissions, we are aiming to creating teams that are more financially savvy, that are, you know, have been in the industry, understands this. I'm not saying we have the high-tech programmers, though. Probably that will be something in the future that will be worthwhile, and maybe we can be back here in a couple of years and talking about that. But as I said, more questions than answers on that one.
John, quickly.
Yeah, certainly most of the you know, the firms or member firms that I've spoken to that fall into the HFT category, I think accept that regulation you know, is coming, and they think that that's a good idea, and they're already planning you know, to become regulated. So I think yeah, that's generally a good thing you know, for the market. In terms of whether it's right for, you know, regulators to start looking at code and you know, test plans to that level of detail, you know, I foresee a lot of problems, including, as Nathalie said, whether the regulator, you know, really has the skills or the desire you know, to go there. And if you decide that that's a good idea, where do you draw the boundaries? You know, is an algorithm used by a high-frequency trading liquidity provider type firm? What is the difference between their algos and, say, the yeah, agency algos within UBS's suite? You know, how would UBS you know, feel about the regulator you know, coming in and reviewing you know, the code there? I think it's you'd have to have one size fits all. So I don't really see that you know, as happening, but I'm in favour of the you know, the regulation of the HFT firms.
Thank you, John. Another question. As we're coming to wrap up this panel, Steve from BIROC mentioned, should we as an industry not get in and solve puzzles? Well, on the earlier topic of consolidated tape, Olaf from Burgundy mentioned Nordic Light. I also understand in Canada, Nathalie, that the regulators solve this puzzle by actually going out with an RFP, a request for proposal, and I believe, am I correct, in that TMX, the incumbent, actually won the mandate.
That was a couple of years ago, before IROC consolidated their orders and trades and before the Maple situation as well. But to my knowledge, and please bear with me, but I haven't been in that group specifically, but yes, they have been awarded the RFP proposal, but I don't think there was any implementation target dates. And for now, we'll wait and see.
Very good, thank you. Well, ladies and gentlemen, if you are a member of this World Exchange Congress, you also have access to the website with an excellent paper from Annika von Haartman, also on some of the cross-market surveillance. Ladies and gentlemen, let's thank our excellent panel. Thank you very much.